Hello and welcome to today's financial news broadcast. Let's start with last night's action on Wall Street. After a tech-led rally in the previous session, U.S. stocks moved into a consolidation phase at higher levels. The Nasdaq closed at 26,584.99. The S&P 500 finished at 7,736.52. And the Dow settled at 54,085.88. On a rolling 24-hour basis, QQQ was up 3.4%, SPY gained 1.8%, with tech heavyweights clearly outperforming the broader market. The Dow was relatively more subdued. Pre-market futures are holding steady this morning. S&P futures are up 0.14%, Dow futures up 0.05%, and Nasdaq futures are roughly flat. That suggests a mildly positive tone for today's open. Stock-level moves were mixed. Nvidia closed at $211.94, down 2.11%, as short-term profit-taking pressure was released. Tesla closed at $327.35, up 0.61%. RKK gained 0.88% to 76.76, showing that small and mid-cap growth names still have some resilience. But here's something worth flagging. Several stocks showed extreme moves. AEHR was up 68% over 5 days. AOI up 72% over 5 days. PLTR up 29% over 2 days. ARM up 24.75% over 5 days. ZBRA up 30.34%. UFPT up 31.26%. We cross-checked these moves and found no official earnings, orders, or M&A announcements to confirm them. So these moves remain unverified and should not be treated as today's trading themes. Now let's look at the global macro picture. The 10-year Treasury yield is at 4.62%, down about 13 basis points from 4.745 a week ago. The 7-day trend is clearly downward, and that's a clear signal of marginally loosening liquidity. This supports valuations for long-duration growth assets. The logic chain is simple. Lower Treasury yields reduce discount rates, which raises the tolerance for growth stock valuations and increases foreign equity allocation appetite. The VIX is at 16.87, within the normal 15 to 25 range. But it rose 2.24% on the day, suggesting sentiment is moving from overly optimistic back toward neutral. As long as the VIX doesn't quickly break above 20, the overall risk appetite direction won't reverse. The dollar index is at 99.74. It's been trading below the 100 level after breaking through it, and while it's roughly flat on the week, it continues to hold below 100. A weak dollar is a double positive for emerging market assets. It eases dollar liquidity tightening pressure and it boosts commodity prices and the purchasing power of exporting countries. Oil and gold are moving up together. WTI is at $75.78, up 0.72%, supported by the U.S. Energy Department's announcement on August 4 of a Q4 plan to repurchase 30 million barrels for the Strategic Petroleum Reserve. That's from the DOE website. Brent is up 1.3% at $80.04. Spot gold is at $4,253.60, up 1.38%, near the high end of its recent range, reflecting continued demand for hedging. The overall read is that global markets are in risk-on mode, driven by the combination of a weak dollar and falling Treasury yields. The conditions for this to fail are if the VIX spikes above 20 in a single day, or if the 10-year yield climbs back above 4.75%. If either happens, the risk-on logic would weaken temporarily. Turning to the yuan and the external environment for Chinese assets. The yuan remains strong. Onshore USD CNY is at 6.7371. Offshore USD CNH is at 6.7489. The onshore yuan has appreciated about 0.2% over the week, and the offshore rate is stable below 6.75. The dollar index breaking below 100 combined with yuan appreciation is favorable for boosting foreign appetite for yuan-denominated assets. The signal to watch is this. If offshore yuan strengthens further past 6.72, expectations for foreign inflows into shares will strengthen. If it weakens back above 6.78, the currency support fades. There's a new development in U.S.-China tech tensions. On August 4, the U.S. Commerce Department's Bureau of Industry and Security published a proposed rule to add 14 Chinese entities to the entity list, focusing on semiconductor packaging and AI computing. That's from Reuters and the BIS Federal Register. On the same day, China's Commerce Ministry responded that it would take necessary measures to protect the legitimate rights of Chinese companies. The rule is still in the proposed stage and hasn't taken effect yet, but the market will start pricing in supply chain restructuring expectations ahead of time. The impact on shares needs to be broken down. Semiconductor packaging and AI computing export chains will face pressure, but the domestic substitution logic for semiconductor equipment and materials will actually be reinforced. Now for today's A-share open. Our base case is a flat open, with a modestly higher open as the secondary scenario. Here's the reasoning. The Shanghai Composite already surged 1.47% yesterday to close at 3,878.43, approaching the 7-day high of 3,881.88. There's short-term profit-taking pressure. But overseas futures are stable, the yuan is appreciating, and treasury yields are falling. That's a triple support. The bulls and bears are roughly balanced. The failure condition is if offshore yuan weakens past 6.78, or if the Shanghai index opens lower and breaks below 3,850. In that case, the flat open call shifts to a lower open. For the index direction today, we expect range-bound trading with a slight upward bias. Yesterday the Shanghai index rose 1.47% to 3,878.43. The Shenzhen component rose 1.86% to 14,144.20. The Chi-Next rose 1.32% to 3,535.14. Those are decent short-term gains. But the 10-year yield at 4.62% and the dollar below 100 cap the downside. We expect the Shanghai index to trade in the 3,850 to 3,900 range. If it breaks below 3,850 on volume, the range-bound call turns to a decline. If it holds above 3,900 on volume, we upgrade to an uptrend. For leading sectors, first is oil, petrochemicals, and oilfield services. The catalyst is the Energy Department's Q4 SPR repurchase plan announced yesterday. Brent rising 1.3% confirms the incremental demand logic. This is the most time-certain sector driver today. Second is semiconductor equipment and materials in the domestic substitution space. The BIS proposed entity list reinforces the urgency of self-reliance. Optical communication modules and semiconductor materials have already seen capital positioning, and we expect continued activity today. But note the divergence within the sector. Companies in packaging and testing and AI computing hardware with business ties to the listed entities will see capital avoid them, while equipment and materials names benefit relatively. For risk sectors, semiconductor packaging and the AI computing export chain are the first to be hit. The proposed entity list rule directly targets this area, and related stocks face sentiment shock risk. Also, theme stocks that have risen more than 30% in 5 days without earning support, whether they're A shares or US-listed names, face profit-taking pressure. Don't chase them. For northbound flows, the three conditions of yuan appreciation, a weak dollar, and stable US stocks support net foreign inflows. Today we're watching the activity of Stock Connect buying and whether the yuan midpoint continues to be set higher. As long as offshore yuan doesn't weaken past 6.78, the probability of net foreign inflows is greater than outflows. Let's wrap up with today's core judgment. A weak dollar combined with falling treasury yields points to a shares trading firm with a slight upward bias. Energy and domestic substitution sectors have the advantage. Avoid semiconductor packaging and testing. Today's probability assessment is 35% for a rise, 45% for a range-bound session, and 20% for a decline. That's all for today's broadcast. Thanks for watching, and we'll see you next time.